You are witnessing a moment that breaks every traditional rule of financial markets. January 26, 2026. Silver trades at $92.91 per ounce, up 234.6% in 1 year. Gold sits at $5,088, up 85.59%. Bitcoin hovers around $87,665 after a volatile recovery. These are not normal price movements. These are not signs of a healthy market-finding balance. This is the sound of a monetary system coming apart at the seams. The data everyone ignores is screaming a warning that most investors refuse to hear. The choice was deliberate. Silver over Bitcoin. Not because of technology or network effects or the promise of decentralized finance, because of physics, because of thermodynamics. Because when the financial system begins to fail, the universe does not care about hash rates or blockchain consensus mechanisms. It cares about what can conduct electricity, what can capture sunlight, what can move electrons from one place to another at the speed that modern civilization demands. And on that metric, silver has no peer. Consider what is happening right now in the physical world. Industrial silver demand hit 680.5 million ounces in 2024, an all-time record. This is not investment speculation. This is consumption, destruction, permanent removal from above-ground supply. Solar panels now account for 29% of industrial silver use, up from 11% just a decade ago. Each photovoltaic panel requires 15 to 25 grams of silver paste to conduct electricity within its cells. By 2026, global solar installations are projected to reach 665 gigawatts, consuming 120 to 125 million ounces of silver annually. This is not a trend that can reverse. The European Union has committed to 700 gigawatts of solar capacity by 2030. China is expanding renewable infrastructure at a pace that defies comprehension. The world has made a political and economic bet on electrification, and silver is the material bottleneck. Now add electric vehicles. A traditional internal combustion engine uses 15 to 28 grams of silver. A battery electric vehicle uses 25 to 50 grams, with some estimates reaching as high as 1 kilogram per vehicle when advanced solid-state batteries enter mass production. Samsung's new silver carbon composite battery technology represents a quantum leap in EV performance, but it comes at a price measured in silver consumption. Global EV production is forecast to reach 14 to 15 million units in 2026. Electric vehicles will overtake traditional cars as the primary source of automotive silver demand by 2027, and by 2031, they will account for 59% of the automotive silver market. This is structural. This is irreversible. Every vehicle electrified is silver permanently embedded in wiring, in battery management systems, in power electronics that cannot be easily recovered. Then there's the infrastructure no one talks about. Data centers, artificial intelligence, the invisible architecture of the digital economy. Global data center power capacity has increased 53-fold since 2000, from 0.93 gigawatts to nearly 50 gigawatts in 2025. AI alone is expected to drive electricity demand growth of 31% over the next decade. And how is this power transmitted? How are these massive server arrays connected? Silver, the lowest electrical resistance of any metal at standard temperature, the material that makes high-frequency trading possible, that enables 5G networks, that connects every transformer and relay and capacitor in the modern grid. The digitalization of the global economy is not reducing demand for physical commodities. It is accelerating it. And silver sits at the center of this transformation. The supply side is where the nightmare truly begins. The silver market is projected to remain in deficit for the fifth consecutive year in 2025, with a shortfall of 149 million ounces. By 2030, research indicates that global silver demand could reach 48,000 to 54,000 metric tons per year, while supply, if it continues on historical trends, will reach only 34,000 metric tons. That is a gap of 30 to 38%. The market will satisfy only 62 to 70% of demand. This is not a temporary imbalance that higher prices can immediately correct. Over 70% of silver production comes as a byproduct of mining other metals like copper, lead, zinc, and gold. When copper prices fall, silver output contracts regardless of silver's price. When gold mines reach depletion, their silver byproduct disappears. There is no lever to pull that suddenly floods the market with new supply. Mining projects take 7 to 10 years from discovery to production. The deficit is structural. It is baked into the geology of how silver exists in the Earth's crust. Now we need to talk about what this means for Bitcoin. The narrative around digital gold has been compelling. Scarce, portable, censorship-resistant, programmable. All of these attributes are real, but they exist in a context that is rapidly changing. Bitcoin's energy consumption is not a minor externality. It is the defining characteristic of the system's security model. As of 2026, the Bitcoin network consumes approximately 175.9 terawatt hours of electricity per year, more than entire countries like Poland or Argentina. Each Bitcoin transaction emits roughly 672 kilograms of carbon dioxide, equivalent to driving 1,600 kilometers in a gasoline-powered car. The resulting annual emissions total 98 million metric tons of CO2, comparable to the entire nation of Greece. And here is the part everyone ignores. 48% of Bitcoin's electricity in 2025 still came from fossil fuels. Despite industry claims of a renewable energy transition, key mining states like Texas and Kentucky source up to 85% of their electricity from coal and natural gas. The Cambridge Center for Alternative Finance reports that 52% of Bitcoin mining now uses sustainable sources, but that statistic is misleading. It includes hydropower, which has massive environmental impacts of its own. True solar and wind energy provide only 7% of Bitcoin's total consumption. The rest is methane capture from oil fields, repurposed coal plants running on natural gas, and grid power sourced from whatever is cheapest at any given moment. This is not sustainable in a world that has committed to net zero emissions targets. The International Monetary Fund warns that by 2027, cryptocurrency and AI combined could consume 2% of global electricity. The European Securities and Markets Authority and the European Central Bank have suggested that using renewable energy for Bitcoin mining may limit the availability of clean energy for the general population. Canada paused new Bitcoin mining connections to its hydroelectric grids in 2022. The European Commission invited member states to end tax breaks and incentives for crypto mining during the energy crisis. These are not fringe concerns. These are the opening moves of a regulatory clampdown that will only intensify as energy scarcity becomes the defining constraint of the 2030s. This brings us to the most dangerous signal in the market right now, the gold to silver ratio. For most of modern history, this ratio has oscillated between 50 to 1 and 80 to 1. In April 2025, it spiked above 100 to 1, meaning 1 ounce of gold was worth more than 100 ounces of silver. This was a statistical extreme, more than 2 standard deviations above the long-term average. As of late December 2025, that ratio had compressed to approximately 57 to 1. In January 2026, some sources report it in the 55 to 65 range. That is a collapse of nearly 45 points in less than a year. This is not normal volatility. This is a fundamental repricing of relative value between two metals with entirely different demand drivers. Gold is performing its traditional role. Central banks purchased 1,045 metric tons in 2024, with 333 tons acquired in the fourth quarter alone. This is reserve diversification. This is geopolitical hedging against dollar hegemony. This is the slow grinding process of global monetary restructuring. Gold's 85% gain year to date reflects this reality, but silver's 234% surge is something else entirely. It is the market screaming that industrial consumption is overtaking investment demand, that physical scarcity is overriding paper price discovery, that the real economy needs this metal more desperately than the financial system needs another safe haven asset. The divergence becomes even more stark when you examine the flows. Gold ETFs like GLD saw 18.9% inflows over the last 3 months. Steady, institutional, predictable. Silver ETFs like SLV recorded $2.57 billion in inflows over the past year, with quarterly gains of 21.66% in net asset value. That is retail and industrial buyers scrambling for exposure before supply constraints bite even harder. The physical silver market is showing stress fractures that paper markets cannot hide. Export restrictions from major producing countries have created regional price premiums. Lease rates for physical silver have spiked well above historical norms, signaling that holders are demanding compensation for releasing metal into the market. These are not symptoms of speculative froth. These are symptoms of genuine scarcity. And here's where the choice between silver and Bitcoin becomes existential. Bitcoin's value proposition rests on the assumption that the current financial system will continue to function well enough to support the infrastructure Bitcoin requires. Mining operations need stable electricity grids. Exchanges need reliable internet connectivity. Hardware manufacturers need global supply chains for semiconductors and specialized chips. All of this assumes a world where complex systems remain operational. But what happens when energy becomes the primary constraint? What happens when governments are forced to choose between powering hospitals or powering Bitcoin mines? What happens when the physical world reasserts its claim over the digital abstraction? Silver is not an abstraction. It is 47 protons and 60 neutrons arranged in a face-centered cubic crystal structure. It conducts electricity better than any other element on the periodic table. It reflects 95% of visible light, making it essential for mirrors and optical applications. It has antibacterial properties that make it irreplaceable in medical devices. It can be drawn into wire 1/10 the diameter of a human hair without breaking. These are not features that can be coded around. These are physical laws that no amount of venture capital or protocol upgrades can change. The Bitcoin network, for all its technical elegance, is fundamentally parasitic on the broader energy infrastructure. It consumes vast amounts of power to secure a ledger that processes roughly 7 transactions per second. The global financial system handles over 700 billion digital payments annually. Visa can process 65,000 transactions per second if needed. Bitcoin's maximum capacity represents 0.03% of this volume. It is not a replacement for the existing system. It is a niche store of value that only functions as long as cheap energy remains abundant. And cheap energy is the one thing the 2030s will not have in surplus. Now consider the timeline. Settlement speed. The velocity of price movement relative to your ability to act. Bitcoin transactions can take 10 minutes to an hour depending on network congestion and fee levels. Silver and gold are bearer assets. Possession is title. There's no counterparty risk. There's no blockchain to sync. There's no exchange that can freeze your account or implement withdrawal limits. The metal exists in physical space, and whoever holds it owns it. In a crisis, this difference is not marginal. It is binary. It is the difference between having an asset you can deploy immediately and having a claim on an asset that depends on infrastructure remaining operational. The current market setup reveals a profound contradiction. Stocks are near all-time highs. Gold is at all-time highs. Silver just hit levels not seen in decades. Bitcoin recovered from a significant correction, but remains volatile. All of these assets are rising simultaneously, which violates the traditional logic of risk-on versus risk-off behavior. When stocks rally, defensive assets like gold should underperform. When gold surges, it usually signals fear that depresses equities. But right now, everything is moving up together. This is not a sign of a healthy economy allocating capital efficiently. This is a sign of currency debasement so severe that investors are fleeing into anything that is not fiat money. The Federal Reserve cut rates to 3.75 to 4% in October 2025. The dollar index has fallen 9.54% over the past 90 days, now sitting at 98.19. The 10-year Treasury yield has dropped 4.69% in the past month to 3.978%. These are the conditions that drive investors into non-yielding assets like precious metals. But here's the critical insight. Inflation is not high right now. The CPI stands at 2.7% year over year as of December 2025, very close to the Federal Reserve's target. The bond market is not screaming about runaway price increases. So why are gold and silver exploding higher? Because the market is looking ahead. Because the deficits are unsustainable. Because the debt to GDP ratios in developed economies have crossed thresholds that historically end in currency crises or financial repression. Because the energy transition is going to require capital deployment on a scale that makes the Marshall Plan look like a rounding error. Because the demographic collapse in advanced economies means lower growth and higher spending for decades to come, the market is not reacting to current inflation. It is pricing in the structural inevitability of monetary debasement as the only politically viable path forward. This is where the system breaks. When traditional correlations fail, when diversification stops working because all financial assets move together, when the only true hedge is physical goods that cannot be printed, that cannot be confiscated digitally, that exist independent of any government or institution's promise to honor obligations. Bitcoin was supposed to be this hedge. And for a certain type of risk it is. But it is not a hedge against energy scarcity. It is not a hedge against technological disruption of the power grid. It is not a hedge against governments deciding that energy-intensive computation is a luxury they can no longer afford. The final verdict is this. We are entering a regime where the real economy and the financial economy are diverging at an accelerating rate. The real economy needs copper for wiring, lithium for batteries, rare earth elements for motors, and silver for electronics. The financial economy needs functioning markets, reliable clearing systems, and confidence in counterparty solvency. These two worlds are separating. Financial assets derive their value from claims on future cash flows, which depend on stable institutions and rule of law. Physical commodities derive their value from thermodynamics and industrial utility. When the system is functioning normally, financial assets outperform. But when the system is under stress, physical goods reassert their primacy. Silver is not just outperforming because of investment demand. It is outperforming because it is disappearing into solar panels and electric vehicles at a rate that exceeds the mining industry's ability to replace. It is outperforming because China and other manufacturing powers are treating it as a strategic resource and limiting exports. It is outperforming because the gold to silver ratio spent a decade at historically elevated levels, creating a coiled spring of relative valuation that is now releasing with explosive force. Holding cash in this environment is a choice to accept negative real returns. Even with inflation near target, the opportunity cost is measured in assets that are rising 30, 85, 234% year over year. But the choice is not simply between cash and any alternative asset. It is between assets that depend on the system continuing to function and assets that retain value if the system experiences discontinuities. Bitcoin requires electricity, internet, and hardware supply chains. Silver requires nothing except the laws of physics. Time itself becomes the enemy. The longer you wait to position for this shift, the less metal is available at affordable prices. The supply deficit is not closing. The industrial demand is not slowing. The regulatory pressure on energy-intensive digital assets is not decreasing. Every month that passes is another 12 million ounces of silver consumed by solar installations. Another million EVs rolling off assembly lines with 25 to 50 grams of silver embedded in their electrical systems. Another data center coming online that needs silver-bearing transformers and connectors to handle the power load. This is not a prediction about what might happen. This is a description of what is happening right now. The data is public. The supply deficits are documented by industry groups and peer-reviewed research. The energy consumption of Bitcoin is tracked in real time by multiple independent indices. The gold to silver ratio is published every second of every trading day. Everything you need to understand this moment is available. The question is whether you are willing to acknowledge what it means. Most investors are not. Most investors are anchored to the belief that the system will muddle through, that central banks will find a way to manage the contradictions, that technology will solve the resource constraints. But the universe does not negotiate. Physics does not compromise. When demand exceeds supply by 30 to 38%, prices rise until demand is destroyed or supply expands. And supply cannot expand fast enough. That is the data everyone ignores. That is the choice that becomes clearer every day. Silver over Bitcoin. Not because digital currencies lack utility, but because when the grid fails, when energy becomes scarce, when the choice is between running a mining operation or keeping the lights on in a hospital, the answer is already written in the thermodynamics of the situation, and silver will still conduct electricity on the other side of that choice.